Hello everyone, and welcome to TradeX Pro. Today, I'm thrilled to guide you through the fundamentals of candlestick charts. This series will cover 4 main topics: the basics of candlesticks, different types of candlesticks, candlestick patterns, and how to read candlestick charts. We'll have at least 6 episodes to dive into each of these areas. Let's start by defining a candlestick chart. This type of financial chart is designed to display price movements over time. Each candlestick on the chart consists of 2 key parts: the body and the wicks or shadows. The body can vary in length, and sometimes it may be very short or nearly absent. Each candlestick reveals information about the opening, closing, highest and lowest prices for a specific time frame, helping investors analyze and predict market behavior. For example, in an uptrend market, imagine the market opens on the left and closes on the right. The price of a stock fluctuates in the morning but rises in the afternoon. We mark the opening price and closing price to create the body of the candle. A green color indicates the stock is trading higher than the previous day. The lowest price of the day is marked as the lower wick, while the highest price becomes the upper wick. As you can see, a single candlestick provides 4 key pieces of information about the market simultaneously. Another example is when the opening price and closing price are close to each other, resulting in a small body for the candlestick. Once again, we identify the lowest point on the chart, which becomes the lower wick, and the highest point, which becomes the upper wick. The color remains green because the price closes higher at the end of the day. Now, let's look at a downtrend market. The market opens on the left and closes on the right. Since the stock is trading lower than the previous day, the body color will be red. The lowest price traded during the day forms the lower wick, while the highest price forms the upper wick. Here's a quick recap. If the opening price is low and the price rises during the day, the candlestick will be green, and we call this a bullish candlestick. On the other hand, if the opening price is high and the price falls during the day, the candlestick will be red, and we refer to it as a bearish candlestick. Let's look at a real chart example. Both charts are one-day charts, meaning each candlestick represents the price movement of a single day. As you can see, they are different. One is continuous, while the other is not. The continuous chart is typically found in the Forex or cryptocurrency markets, where trading activity occurs 24 hours a day, almost every day of the week. The discontinuous candlesticks on the right chart are usually seen in the stock market, where trading only happens during the day and is closed at night. A new candlestick starts with the new trading day or session. If we zoom in on the continuous chart, the closing price on the second day will be the same as the opening price on the third day. Similarly, the closing price on the 6th day will match the opening price on the 7th day, and the closing price on the 11th day will be the same as the opening price on the 12th day. On the discontinuous chart, the closing price on the 6th day may not be the same as the opening price on the 7th day. We call this a price gap. Similarly, there is a significant gap down between the closing price on the 9th day and the opening price on the 10th day. This price gap can result from news and events, economic data releases, company announcements, or off-hours trading. Alright, now that we've covered the basics of candlestick charts, let's delve into understanding the meaning of each candlestick by examining its body and wicks. Let's start with some examples. This candle has no body but long wicks. This candle has a large body but short wicks. This green candlestick has a small body and very long wicks. Some candlesticks have only upper or lower wicks. Here is an important question: what information does each candlestick provide? Let's look at these examples. A green candle with a big body indicates that the closing price is significantly higher than the opening price, reflecting a strong upward movement in the stock or asset during that trading period. This type of candle is called a bullish candle, signifying that demand is greater than supply. In contrast, if the closing price is significantly lower than the opening price, it indicates that the stock has lost momentum during the day, resulting in a red candle with a large body. This type of candle occurs when supply exceeds demand. Here's an interesting example. When a candlestick has a very long lower wick, it shows that the price falls significantly during the day, but then rises back up by the end of the day. This long lower wick indicates strong buying pressure and suggests that buyers were able to push the price back up after a dip. Similarly, if a candlestick has a very long upper wick, it shows that the price rises significantly early in the day, but then falls by the end of the day. This indicates that while buyers initially pushed the price up, sellers were able to drive it back down, reflecting strong selling pressure. What if a candlestick has a small body and long wicks on both ends? The small body indicates that the opening and closing prices are close to each other, reflecting a lack of clear direction or strong consensus in the market during that period. The long wicks show significant price movement above and below the opening and closing prices, suggesting indecision or a battle between buyers and sellers. Again, a very small body or no body at all signifies indecision or uncertainty in the market. It shows that neither buyers nor sellers were able to gain control during that trading period, resulting in the price closing nearly where it started. The last example is quite interesting. Typically, a red candlestick indicates a downtrend in the market. However, if the candlestick has a very long lower wick, it suggests strong buying pressure that pushed the price back up, nearly turning the candle green. This type of candlestick represents the weakest form of bearishness due to the significant buying pressure. Let me give you a quick recap on candlestick strength. For a bullish candlestick, the strongest type features a large body, showing a significant increase from the opening to the closing price, which reflects strong upward momentum. On the other hand, the weakest bullish candlestick is one where buyers push the price up initially, but sellers then drive it back down, indicating substantial selling pressure. This concept also applies to bearish candlesticks. The strongest bearish candlestick is the one with a large body on the left, indicating a significant drop from the opening to the closing price and reflecting strong downward momentum. Conversely, the weakest bearish candlestick is the one on the right, where the price initially falls but then recovers, showing strong buying pressure that mitigates the bearish trend. Why is this important? Here's why. A weak candlestick can signal a potential reversal in the market. When a candlestick shows weak momentum, whether bullish or bearish, it may indicate that the current trend is losing strength and a change in direction could be on the horizon. Let me show you some examples. In an uptrend chart, if the price has been rising for an extended period, but then you observe two consecutive candlesticks with long upper wicks, this signals weakness. In these cases, buyers initially push the price up, but sellers drive it back down on both days, indicating a potential reversal in the overall market trend. Similarly, in a downtrend chart, if you see a candlestick with long lower wicks after several days of declining prices, it signals weakness in the downward trend. This pattern suggests that the selling pressure is weakening, which may indicate a potential reversal to the upside. Now, let's move on to the final topic of this video: the drawbacks of candlesticks and how they can sometimes lead to misinterpretation of market information. Consider two one-day market charts on the left. They look different. However, if you represent them with a candlestick chart on the right, they appear the same despite conveying different meanings. In the top chart, the market seems flat at the end of the day, while in the bottom chart, the market is rising towards the end of the day. This misinterpretation can lead to inaccurate predictions for the following day. To solve this problem, it's quite easy. Simply zoom in or change the time frame of the chart. By doing this, you divide a full day's data from a single candlestick into multiple smaller candlesticks. For example, in the first period of the day, you might see a big green bullish candle, while in the second period you get a big red bearish candle, and so on. This approach reveals the correct hidden trend and ensures both types of charts convey the same meaning. Now, if we revisit the example from the beginning of this topic, the misinterpretation of market data from a single candlestick can now be resolved. By simply dividing the data into smaller segments and creating multiple candlesticks, the true information and trend of the market are revealed. Let me show you an example using real data. The chart on the left is a one-day chart, where each candlestick represents 1 day of trading data. In contrast, the chart on the right is a 4-hour chart, where each candlestick collectively shows 4 hours of trading data. Since 1 day has 24 hours, one candlestick on the left corresponds to 6 candlesticks on the right. Let's pick a candlestick in the middle, representing February 6th. On the 4-hour chart, this can be expanded into 6 candlesticks. The last 2 candlesticks at the end of the day indicate an upward trend, which can be beneficially used to predict the market direction for the following day. On February 7th, the single candlestick on the 1-day chart shows a strong upward movement. However, if we expand this to the 4-hour chart, a different story emerges. The market fluctuates throughout the day, and the last candlestick shows weakness through a long upper wick. This indicates selling pressure at the end of the day, which pushes the price down on the following day. This market behavior can only be observed in the lower time frame chart. Alright everyone, that wraps up our first video lesson. Stay tuned for the next session where we'll explore different types of candlesticks. See you next time.